Welcome back to the deep dive. Today we are plunging into something really fascinating. It's this mashup of high stakes Indian finance and, well, some seriously cutting edge silicon technology, all focused on 197 Communications Limited, Paytm.
That's right. It's quite a combination to unpack.
Yeah, and our sources for this deep dive, they're pretty dynamic. We've got the Q2 FY 2026 earnings release, super granular detail there for the quarter ending September 30, 2025. But then alongside that, there's this major press release that dropped at the same time, all about a core AI technology partnership.
Right. Two distinct sources painting one big picture.
Exactly. And our mission here, it's not just to read out the numbers. We want to synthesize this stuff, understand how this deep tech commitment, this very specialized AI thing, is translating immediately into efficiency and, well, profit. Specifically, how did they manage these huge cost cuts while actually spending more on sales? That's the puzzle.
Yeah. And what's fascinating, I think, is that the sources give us this rare look at a real efficiency flywheel kind of in action. We're moving way past just AI as some simple optimization tool. This is really a story about leveraging real-time AI to fundamentally change the cost structure, drive tangible operational efficiency that, well, like you said, we can see hitting the balance sheet right away.
Okay, so let's start with that tech foundation then, because it feels like the key enabler for the whole financial story, right? The big headline, sort of tucked away, was this partnership with Grok, a U.S. company leader in real-time AI inference. That seems like a massive strategic choice.
It is a big bet.
And the technical detail that really matters here, you mentioned it, it's the hardware. Grok uses the specialized LPU architecture, language processing unit. They built this chip specifically for lightning-fast AI inference.
Right. And this is, I think, a really crucial distinction for you, the listener, to grasp, because it explains the risk, but also the potential reward here. Think about it like this. Most AI platforms, they run on GPUs, right? General purpose unit?
Yeah, the standard stuff.
Exactly. And a GPU, it's like a really powerful Swiss Army knife, great for training AI models, good for general computing too, very versatile. But the LPU, that's different. It's like a laser-focused surgical tool, purpose-built for just one job, running AI models after they're trained. That's the inference part. And because it's so specialized, it just enables significantly faster, more cost-efficient, and really scalable inference compared to those regular GPU systems.
Okay, faster, cheaper for running the AI. So why does that specifically matter for a payments company like Paytm? Speed, I guess.
Speed is absolutely everything in this business, exactly. Any latency, any delay in payments or risk assessment, that equals lost money or increased fraud. Simple as that. So by using Grok Cloud, they're getting these real-time capabilities for stuff that's absolutely mission critical. Think enhanced transaction processing, immediate risk checks, instant fraud detection, hyper-personalized customer engagement. If your AI can spot fraud risk even milliseconds faster across millions of transactions daily, that is enormous financial leverage. Huge.
Okay. But I have to ask about the risk here. I mean, that's a big shift, isn't it? Moving away from standard cloud stuff like AWS or Google Cloud isn't relying on this, specialized LPU thing from just one vendor, kind of a major dependency risk, especially for a core payment system.
That's a really important question. It definitely is a calculated risk, no doubt about it. But the sources seem to imply that the payoff, in speed and cost efficiency, it justifies that risk for them. The collaboration is explicitly aimed at building, and I quote here, India's most advanced AI-driven payment and financial services platforms.
Okay, lofty goal.
Yeah. And to deliver those instant, intelligent, and reliable experiences, they probably figure they need that architectural edge. So they're betting the specialized performance boost outweighs maybe the general flexibility you get from a standard cloud provider. It's a strategic gamble.
All right, okay. So let's trace that tech bet, that gamble, through to the actual financial results. Quarter ending September 30, 2025. We'll try to keep the numbers concise, focus more on the implications, not just rattle off data points.
Sounds good.
So top line, it grew strongly. Operating revenue was up 24% year over year. That's 2,061 CR. And actually, if you adjust for that entertainment business they sold off before, the growth looks even better, right? Like 27% year over year.
27%, yeah. So really solid growth in the core services, absolutely. But the critical shift, the big story, I think, is the move to sustained profitability. EBITDA. Earnings before interest, taxes, depreciation, amortization. It improved dramatically. Came in at 142 CR. That's a 7% margin. which is just
Yeah.
a massive turnaround from the negative margins they had just a year ago.
Huge swing.
Huge. But the real health check, I always think, the fundamental economics of the business, that shows up in the contribution profit. That hit 12,207 CR, up 35% year over year.
Wow.
And even more importantly, the contribution margin itself improved by 5 full percentage points year over year. It hit a really robust 59%.
59%. Okay, that number jumps out.
59%, yeah. I mean, that's a margin plenty of mature tech companies would kill for. And it really speaks to like extreme operational focus and maybe some pricing power too.
Yeah, that 59% margin feels like the anchor for the whole report, doesn't it?
Yeah.
It says the basic unit economics are really working. Okay, let's quickly mention the bottom line. They reported profit after tax of 21 CR, but we should clarify, right? Before that one-time charge we need to talk about later, the figure was actually much higher.
Yeah, pre-charge, it was 211 CR. So the underlying profit was strong. The reported number was hit by that specific item.
Got it. And finally, just quickly on cash, their position looks pretty strong.
Very strong.
Total cash balance, 13,068 CR. And that balance got a nice boost, partly from monetizing stock rights, and PayPay added about 2,372 CR.
Right. So they've got a healthy war chest sitting alongside that accelerating core profitability. Good position to be in.
Okay, so strong profits, cutting-edge AI. Now let's connect those dots.
Yes.
Were those margins just from, cutting corners? Or was it real structural efficiency? Let's trace it back to operations segment by segment.
All right, let's start with payments and merchants.
Okay, so on the payments side, the physical presence, the devices, still key. Merchant device subscriptions hit 1.37 CR. That's up 25 lakh over the year. Good growth. And that subscription model gives them predictable revenue.
Predictable revenue, exactly. And the GMV gross merchandise value that also grew nicely, 27% year over year, hitting a 5.67 lakh CR. Big numbers.
But the operational story here, the really interesting bit, is the product innovation that AI seems to be enabling. They previewed India's first AI soundbox.
Oh, yes, the soundbox.
Yeah. So this thing, it's not just a little speaker making a noise when a payment comes through anymore. They've apparently transformed it into an intelligent business assistant for the merchant, using AI to give real-time insights on sales trends, payment summaries, like turning a notification box into a mini data terminal.
That's a great way to put it. And you see that tech edge translating directly into user growth, user stickiness. Their monthly transacting users, MTU, grew to 7.5 CR. That's up 6% year over year. And they explicitly link that consistent market share gain to product improvements and, importantly, adding these AI features. Makes sense, right? Make the product faster, smarter, more useful. People stick around.
Yeah, makes sense. Oh, what about the second pillar? Financial services distribution.
Right. This segment saw some really significant acceleration. Revenue jumped 63% year over year. Massive growth. Hit 611 CR.
63%. Wow.
Yeah. And the role of AI here seems absolutely central to managing that kind of explosive growth, but doing it responsibly. Because the growth isn't just about, handing out loans. It's driven by strong merchant loan distribution and, critically, much improved collection performance.
Ah, collections. Okay.
Yeah. They're using these advanced AI models, apparently, to intelligently predict merchant churn and also potential delinquencies, which lets them engage proactively, right? Instead of just reacting and chasing debt after the fact. That significantly lowers their credit risk profile.
Which makes them more attractive to their lending partners, I assume.
Exactly. Hugely attractive.
And speaking of lending partners, they also relaunched a big consumer product, didn't they? Paytm Postpaid.
Yes, the spend now, pay next month thing. It's a UPI overdraft offered with a bank partner.
Sounds like a pretty strategic move, leveraging that huge UPI user base they have for, higher margin financial products.
Definitely looks that way, tapping into the existing ecosystem.
Okay, now for the part that ties it all together, cost.
Yes. This is where the whole narrative clicks, I think.
Yeah.
And it answers that initial question about the 59% contribution margin. This is the why.
Lay it on us.
Okay, so overall, indirect expenses for the whole company, they decreased 18% year over year. Pretty good. But let's zoom in on employee costs. Non-sales employee costs declined, wait for it, 41% year over year.
41%. Hold on. That's an astounding reduction in, overhead labor costs.
It really is staggering. And the company explicitly says this sharp drop is down to two things. One, improved productivity by leveraging AI. That ties directly back to the Grok partnership, right? Real-time AI driving tangible, immediate productivity gains. Think back office, tech roles. And two, lower ESOP costs, because the founder CEO voluntarily gave up his stock rights back in Q4 FY 2025.
Right, okay, so AI efficiency is a major driver there.
Major driver. This is the proof point.
Okay, now here's the strategic contrast that makes this so interesting. You flagged this earlier. They cut non-sales costs by 41%, but their sales employee costs went up 38% year over year.
Exactly. That's the flywheel. They're taking these massive efficiency gains, likely generated by that new AI backbone, and immediately plowing that capital back into physical expansion. That 38% jump in sales costs means they're aggressively hitting the streets, expanding the merchant distribution network, especially targeting growth in Tier 2 and Tier 3 cities.
So classic strategy. AI cuts the overhead, and those savings fund the boots-on-the-ground sales growth.
That's precisely the picture painted by the sources. Efficiency driving expansion.
Okay, but before we get too carried away with the profitability story, we absolutely have to talk about the external factors, the risks they navigated this quarter, especially the regulatory stuff. That forced some pretty significant structural and financial changes, didn't it?
It absolutely did. Let's start with the really central piece of, well, regulatory success for them. The payment aggregator status. Their subsidiary, Paytm Payment Services Limited PPSL, got in-principle authorization from the RBI, the Reserve Bank of India, back in August 2025.
And that's fundamental, right? Lifts restrictions.
Total fundamental. Before that, they had restrictions on signing up new merchants. Now those are lifted. So their core growth engine can basically run unimpeded again. Big relief.
Okay. And tied directly to getting that license is this massive investment they announced. The board approved up to 2,250 crores. What's that? About $275 million US into PPSL via a right issue. Why so much money?
Yeah, it's a huge number. It seems to be for two main reasons. First, just strengthening PPSL's net worth, meeting the regulatory capital requirements, standard procedure. But second, it funds the actual transfer of the offline merchant payments business into PPSL. So they're basically consolidating everything, online payments, offline payments, under this single, newly authorized entity.
Ah, okay. Streamlines things for compliance down the road.
Exactly. Makes operations and future regulatory dealings much cleaner.
We also need to address that one-time financial charge, the one that hit the reported profit after tax figure we mentioned.
Right, the impairment. That was a specific charge of 190 CR. It was for the full impairment of a loan they were given to their joint venture, First Games Technology Private Limited, or FGTPL. And this charge basically became unavoidable because of a new law, the Promotion and Regulation of Online Gaming Act 2025, which, well, as the name suggests, prohibits online gaming.
So a direct hit from a sudden regulatory change in an adjacent market.
Precisely. A clear example of how fast regulatory shifts can impact the bottom line, even for related ventures.
Okay, and finally on the regulatory front, we should probably touch on that long-running issue, the show cause notice regarding alleged FEMA contraventions. Foreign Exchange Management Act. That originally alleged something like 611 CR.
Yeah, that's been hanging around. But this quarter brought a positive resolution update, actually. The RBI essentially settled a chunk of it. They imposed a relatively small penalty compounding, they call it, on about 21 CR of the allegations. And importantly, they observed compliance for another 312 CR relating to a separate subsidiary.
So, mostly resolved.
It looks like they've successfully navigated and complied with a significant portion of what the RBI was looking at, which reduces the overall liability and, removes a chunk of uncertainty. That's always good.
Okay, good context. And just to wrap up the corporate updates, there was one more point that actually links back to where we started, with the AI strategy. The appointment of Ms. Manisha Raj Raisingani as a non-executive independent director.
Ah, yes. That's significant.
She's described as an AI and SaaS expert, founder-CEO of SiftHub. Having that kind of specific expertise right there on the board, that really underscores their commitment to the whole tech strategy, doesn't it?
Absolutely. It signals that AI isn't just an operational tool, it's a board-level strategic priority. Sends a strong message.
Okay, so let's try and summarize this whole deep dive then. It feels like a lot happened this quarter.
It really does.
Yeah.
I think to boil it down, the sources paint this picture of a really successful, albeit complex, transition period. They've clearly secured strong core business profitability. You've seen that 59% contribution margin, the positive EBITDA. That's solid. And at the same time, they're investing heavily in this clear technological edge with Grok's LPU architecture. And crucially, they successfully navigated some very tricky regulatory hurdles to secure their long-term operating license from the RBI via PPSL. It's firing on multiple cylinders.
Yeah, the narrative seems really clear. AI is the key differentiator now. It's not just talk. It's driving specific, measurable cost cuts. That 41% drop in non-sales costs is just phenomenal,
That's
really.
huge. Yeah.
And those savings aren't just padding the bottom line, they're being strategically plowed back into funding that physical expansion into new markets, making sure the growth stays efficient and profitable.
The flywheel in action.
Exactly. So this leaves us with a final provocative thought for you, the listener, to chew on. Given that the company did just take a big financial hit, that 190 CR impairment because of a specific regulatory ban on online gaming, and we know they're actively looking at international expansion now, considering both partner-operated and maybe even Paytm-operated models for future growth. The question is, how quickly will the speed and efficiency gains from this new real-time Grok AI stack actually enable them to diversify revenue streams outside of India?
Interesting question.
Could that core technological leap, that speed advantage, be the key to unlocking new global markets much faster than relying on older, slower, legacy hardware would ever allow? Something to think about.